We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chase Taylor, global macro strategist and editor at Pinecone Macro Research, as well as the head of research at Bulwark Capital. Chase, thanks for joining me today. How are you?
Yeah, great to be back. I'm doing well. How about yourself?
Excellent, Chase. It's always a pleasure to speak with you, and again to be able to dig through your work and find some relevant topics to talk about. And as always, I can't believe that it's been over a year since you and I have spoken. And just the sheer amount of noise and quote unquote happenings that have transpired in the last year is crazy to think about. But I want to start by asking you something that you and I talked about the last time we spoke, and that was basically recession fears. Are we now closer than ever to a recession, or is there some force that is keeping us from going into recession, and somehow the country has the ability to really kick this down the road forever?
Yeah. So I don't think forever by any means, but I do think there is a force that makes it really hard. It's like a, if you're doing limbo, it's like the bottom rung. It's just difficult to get under that, and that's probably obvious to a lot of people by this point. Maybe not so much a year or two ago, and that's just the deficit. Like the deficit, especially actually combined with higher interest rates, is just incredibly stimulative. It's new money that gets put into the economy, and some of the mix of how it enters the economy is actually pretty stimulative as well. So given that, it does make it very tough. Not impossible by any stretch, but tough. I was one of the people that got it very, very wrong in, 2022 or 23? I can't remember now. I think 23 was about the time it started to finally shift, late 23. But they just got it dead wrong, thinking like, oh, these quick rate hikes are going to shove us right into recession, without recognizing, most importantly, like if no one's paying the new rate, it doesn't matter. And the reality is the short end rate, not a lot of people pay. So yeah, it hurts small businesses. It hurts, the bottom quartile of the economy. But when you do the math on how much that impacts the broad economy, it just doesn't. So as long as asset prices are doing well and you have a big a deficit, it is very, very difficult. But I'll kind of throw in the one big caveat, and that is the housing market. I do think if you got enough stress in the housing market where enough layoffs were attached to it, then you could have a normal, just, the cycle problem, where you kind of hit the event horizon with employment, where it hit demand enough to hit other employment, and then it's just dominoes, right? And then you just have to reset the thing. So I think anyone that's thinking about this, kind of viewing the whole system, you have to kind of look at it as, is a recession impossible? Not at all. Is it less probable than what we were used to in 40s, 50s, 60s, 70s, 80s, 90s? Yeah. And back then, it was like everything was manufacturing and inventory cycles, and that stuff is so cyclical. But is Google's business cyclical? Not really. So all the tech stuff these days, very high margin, very low cyclicality. So it's difficult for stocks to like durably take a big hit. It's difficult to see, tech layoffs that hit, 10% of employment or something like that. So I think the economy is naturally more resilient than it used to be, as long as asset prices are up and as long as the deficit's high. And we did get a scare back in April that, hey, maybe the trade deficit's coming down in a big way, and maybe the budget deficit can come down. But now here looking at it in July, it's kind of obvious that the budget deficit's not coming down, and the trade deficit probably not either, just throwing some tariffs in there.
Well, those are a couple topics that I'd like to go through, but I want to go back to kind of what you said at the start there. We think of rates being high as a constraint on the economy, especially after, basically decades of lowering and lower rates than where we are right now. Why are these higher rates stimulative?
Yeah, at the end of the day, I mean, the rate is getting paid to, institutions, to people. I think, here we are at an RIA, and, we don't keep cash, we keep cash in T-bills, right? And that's just a free 4% coupon to clip. And if you're a millionaire and you have, let's say you're worth $8 million and you have 2 million of it just grabbing 4% for you, like that is stimulative to your bottom line. That makes you more likely to spend some of that money. And then obviously if you're, Warren Buffett and you have billions in T-bills, like he's making a shocking amount of money just by parking his money with zero risk. And at the end of the day, the debt load is so much bigger than it was 10, 20, 30 years ago that there's that much more interest. And on the flip side, you get the fear mongering of like, and hey, I participate in this sometimes, like of, man, the deficit like is going to get worse because it's over $1 trillion of it's just interest on the debt. And like, yeah, that's bad for the government, but that's all just a surplus straight to the private sector. So, President Trump's been berating Jay Powell over this. Like, we got to cut this so we get the interest costs down. It's like, be careful what you wish for, because if you get the interest costs down, like that's good for the government's balance sheet, but bad for the private sector's balance sheet, and you could actually mess with growth a little bit. So, it's almost like a curve where one thing is true. In this case, rates up being bad is true, and then you kind of pass this point of the curve where it's like, actually, within reason, it's actually healthy for the private sector. Obviously, you could argue that there's a threshold that you get to that runaway fiscal dominance area where you have big currency problems and big societal problems. But for now, it's just honestly, to me, if we raise rates to 8% tomorrow, would some small businesses go out of business? Yes. Would some private equity stuff blow up? Yes. But would the broader economy get smashed? Maybe not, because there'd be a lot of interest income. With again, that one caveat of housing.
Right. Well, when we think about, let's say, the real rate of return on that, does that factor in to, let's say, people's thinking or your thinking around that as well? Or is this, we're basically just looking at the nominal rate of return just because that's what people can get for parking their money in a T-bill?
I think the real rate of return always matters. I don't think it matters to most people, and I think largely because as Americans we've been able to take for granted that the real rate and the nominal rate were so close together. I'm of the belief that 2020 probably changed that for a while, and I do think that at the end of the day we're going to have to get to the real rates being deeply negative to kind of inflate away the debt, but. For now, real rates are pretty high. Even real wages are relatively high, and that stuff does help keep the economy doing well. If you get into a situation, especially where real wages get negative again, then consumption can become a bit of a problem. But when you're taking net immigration to pretty extreme lows, that starts to put a lot of pressure on wages to pick up. Both nominally and I would assume on a real basis, although. Maybe not on a real basis, because that will be inflationary.
Mm-hmm. Well, you mentioned this idea of fiscal dominance, and especially at these debt levels, that seems like a real threat. And I know this is a complicated problem to analyze, but where do you think we cross that threshold of entering that, let's say, a doom loop, if you will, of fiscal dominance?
I wish I had like a really firm number to put on it, because that would be very useful. Mm-hmm. The answer is I don't know, but I think you'll know it when you see it. And I think if the president had his way, you would see the signs of it kind of before it was real. But I think when you have a situation where the Fed's cutting interest rates when they obviously should not be from just a normal macroeconomic standpoint, that's when you'll know, like, oh, okay. Like they have to serve a different master now. Like the inflation mandate takes a massive backseat to a fund the government mandate. That would be very obvious. If you had 3-4% inflation, and the Fed was like, you know what, we got to cut and we got to do QE, or some sort of yield curve control, whatever the case may be. That would be your sign that we're in fiscal dominance. And the reason I say like we might get there earlier than we have to is like obviously we don't have to do that right now. Um, it'd be helpful for the deficit, but we don't have to do it right now. Like people are buying the debt. Congress, has no incentive to slow down spending or anything. Voters don't care, right? Like no one cares. So they don't have to do it right now. But maybe, maybe the Fed does become pliable enough next year to cut, let's say 1-2% below where they probably should. Then you could argue like, all right, you're already there from like a way the market has to interpret its standpoint.
And do you mean by next year being once the new Fed chair steps in after J. Powell?
Yes, but I'll put a big disclaimer on that because this is something that's driving me nuts lately. Everyone seems to think like you just throw someone in there and they'll just do what you say, as if there's not a 12-person committee where they all have an equal vote, right?
Right.
And again, this is something as an American you could just take for granted, like, oh, well, whatever the Fed chair wants, we get. And like, well, yeah, but that's because they normally don't have hardcore political pressure on them to cut rates when they shouldn't. Again, if you have 3.5%, inflation mid next year or something, and the White House says, "Cool, let's cut rates to 1." Obviously, most of the committee would say, "Let's not." But let's say I'm wrong, and they all just become politically docile and say yes, yes, sir, and they cut the rates. Then even though you didn't have to be in 2026, you would kind of be in the same outcome as fiscal dominance. What we are used to seeing in like Latin America or something.
Mm-hmm. So Chase, when we think about what Jay Powell relies on so heavily as being, so data dependent, what are some of those indicators that he's relying on at this point to not cut rates?
He's made it pretty clear that he's the biggest reason he's not cutting is because of tariffs. And this is something where like he's getting some criticism that I think they deserve, and that there's times where they're data dependent, which means just backward looking, and then there's times where they want to like kind of move the goalpost to be like, oh, wait, let's think about how this is going to look in 6 months, and like, okay, like, well, sometimes you care about the past, sometimes you care about the future. It's a little confusing, but at the same time, like I totally get it. Like we're looking at maybe realized tariff rates, effective tariff rates here in a few months, maybe being 25, something like that. Like that's pretty substantial stuff. And we don't know if it's going to be inflationary. And I give kudos to Powell for being like, look, I don't know, but we know it's possible and we don't want to play around with that. So we're not going to. Obviously it'll be inflationary for goods, but maybe it's, disinflationary enough for services for it to cancel each other out enough to not be like a big inflation impulse. That all remains to be seen. My gut says it's going to push inflation back up some, enough to where the Fed should probably not do a bunch of cutting. But other than tariffs, the last few years, they had definitely a big focus on the labor market from not only like unemployment standpoint, how tight it is that way, but also like the wage standpoint. We got a significant spike in wages and an important distribution of that, back right around COVID, because we had a demand shock and a supply shock same time that created incredibly tight labor, gave people a ton of bargaining power. And you had the lowest quartiles of income getting the highest wages, the youngest people getting the highest wages, the least skilled people getting the highest wages. So we were running the economy incredibly hot. And in some ways you could argue like that's terrible because that's really inflationary. And in other ways you can argue like, oh, cool, the people we've left behind for 30 years or whatever, they're starting to pick it back up on a relative basis. I'm of the view, this is controversial, that running things really hot is actually for inequalities is the best thing you can do. Not that necessarily DC is usually particularly solving for inequality, because they're not, but that is the kind of the way I see it. But that labor data is really big for them. And then obviously just, your normal price data, like looking at PCE and CPI and stuff, they're gonna hone in on that stuff hardcore. They're gonna ignore things they can't really control, like oil, as best they can anyway. But I think for now, how much tariff goods inflation sneaks in is going to be really driving the bus.
On the other side of cutting rates, Chase, the Fed's other tool is, going back to quantitative easing, or, quantitative tightening versus easing. The Fed has, really run off a lot of that balance sheet, and really run down the rate at which they were tightening. So once we get, closer to zero, does that end up being a catalyst for them as well to, let's say, need to build that balance sheet back up and go back to QE? Or, can we just basically keep stepping down, let's say, month by month on the quantitative tightening side?
Yeah, I think they're probably pretty close to being done, and I do think that it is a bit of a almost like a prerequisite for them to finish that, to need to turn around and go back to adding liquidity, but not necessarily QE. I think what we're seeing with the supplementary leverage ratio and clearly they're trying to kind of, smooth out the runway for banks to buy more treasuries, probably so the Fed doesn't have to. The Fed and other central banks, kind of across the world have made it clear they want to get out of the, like, putting their thumb on the scales of rates button, all the time. Like, they want to get out of that game. The Fed's made it clear they want to. They probably won't be able to for very long, but I think if they can get away with not doing much with their balance sheet for a while, they absolutely would do that. But let's say the president gets two more people in, that's enough to get them to move rates more than they kind of would have otherwise. My guess is, if you're the boss and you can get them to do that, why not? Why not trying to get them to do some QE too? But so I would not be shocked if they started using the balance sheet again. And obviously, if we have a crisis, they'll come in and, with a fire hose of liquidity, and they'll put the fire out with it, like they always do. But my base case would be not much. I think they're close to being done on it, just because bank reserves are getting too scarce. My assumption is they don't use the balance sheet very much for the next, call it, year to, barring a crisis, and then in which case they would use it indiscriminately.
Right. Well, do you think that the Fed's ability to be effective in a crisis situation and really use that fire hose to its full effectiveness is somewhat diminished now because of this level of debt deficit and just overall currency in the system?
Good question that I'll kind of reframe. I think their liquidity tools are still more than powerful enough, but I don't think the rate tool honestly really matters much anymore. I think the fiscal impulses matters dramatically more than monetary at this point. I mean, if Congress balanced the budget tomorrow, you would have a depression, and if they expanded the deficit by another 20% tomorrow, you would be in another boom of just running it super hot with 8% nominal growth, the whole 9 yards, right? Mm-hmm. So to me, like that's really where the show is. The Fed, by moving, Fed funds between 0 and 6 or whatever, like that, it's kind of like the kid in the back of the car with the fake steering wheel. Like, they're just not really doing that much. But I think, as we saw with, Silicon Valley Bank and all that, like, hey, you go make some alphabet soup facilities and you throw $1 trillion in them, and you tell people that they don't have to mark to market, or that, hey, why don't you just park your trash with us and we'll give you money good for it? Like, all those kinds of things, that all still works. Like, that all still works like a charm when it's needed. But it's more of a liquidity story than a normal kind of old school, central bank policy by just moving the rate around thing. So in a way, yes, and in a way, no.
Mm-hmm. So on the other side of this, Chase, what role do you see let's say, all of the short-term debt that has been put out over the last 4 years, really, like kind of through the end of Yellen's term, and, kind of continuing into Besant's term here? How do you see that affecting the structure of the Treasury and the bond market? And do they still have the ability, or let's say the confidence, the market's confidence, to be able to issue, heavily on the long end as they have in the past?
Yeah, awesome thought here. I think it's one of those things where it's very expedient short term and very kind of foolhardy long term. And I think Besant was right to criticize not having termed out more debt prior, but then he also criticized stuffing us with T-bills, and then made it sound like he would do the opposite. And then as soon as he got in the seat, he changed his tune, and he's just been Yellen 2.0 when it comes to what duration he's issuing. I definitely think it helps keep yields down on the long end by not, by limiting supply. I think that's just kind of basic economics, but I think it sets you up for problems. There's a reason why, if it made sense to just issue, 5 years and under paper, then we would all do that, right? There's a reason 10, 20, 30-year bonds exist. And if we do load up, right? Yeah. If we do load up on 2 year and under, and kind of make that a significant portion of the debt, you're kind of playing with fire, because then if you get an inflation shock, the whole thing re-rates instead of 20% of it re-rates. Like, obviously the math on that is sketchy if you have an inflation shock, and if you're going to play around with tariffs and deporting a bunch of people and stuff, like wars in the Middle East, like you're at least courting small odds of an inflation shock with those kinds of things. Inflation is usually just completely unexpected and uninvited, so it's more of a just don't tempt it thing to me. But obviously, yeah, sure, you could do a bunch of 2 years and have the Fed buy it all or whatever. But that's when you get into the lessons of history that frown upon those things for countries in Latin America and Eastern Europe and stuff. Like there's a reason those are all like case studies. If you get taught monetary policy of things not to do. So for us to load up on the front end and just hope we never have another inflation problem, pretty myopic. And obviously the argument is like, well, inflation is pretty high, rates are pretty high. We'll wait till it comes down, then we'll do it. Maybe, but you can't guarantee that you're going to get that opportunity. So I do think the criticism of we should have termed out more back in the day holds. But at the same time, I remember everyone was saying like, "Oh, rates are really low, so we should just go nuts spending money." Like, well, then rates wouldn't be low, and like I don't know, it's some circular logic in the way people look at that stuff, I think. But yeah, I think it's dangerous to go too much on the short end. So hopefully they change their tune, even if the 10-year, hey, if the 10-year 6, because that's what you had to do to clear it there. I think that's better than having everything on the front and just praying you never get inflation again.
Mm-hmm. And going back to our, original idea of higher rates being stimulative for the private sector, that's, an interesting piece to have to consider and kind of put into that calculus as well.
Yeah. I'm talking about, this is basically QE or I should say, it's like a free paycheck for rich people whenever rates are really high. So imagine, we have an inflation shock, all the debt's at 2 years. Grandma and grandma have, just all their money in cash at this point because it's just yielding so high. Stocks are down or whatever. And then you have to jack rates. And now grandma's like getting just insane checks from the treasury, just for that. Like that would be so inflationary. Mm-hmm. And then it becomes, it's just like a feedback loop where inflation up means yields up, means inflation up means yields up. And that's where that fiscal dominance, you kind of break everything because that feedback loop is so destructive. You have to find a way to break it. So again, shoving everything in the front end would be tempting fate. Now, I do think it's important to note, like if you just zoom out of the average maturity of the debt, like we're still not in like terrible shape. Like, yes, we've done this for the last 5 years or whatever, but the average maturity is still not that bad. So there's still plenty of time for them to right this ship. But, every quarter that goes by that those refunding announcements come out and they go, like let's punt for another quarter. Every quarter that goes by, there's some more duration that pushes off the balance sheet and more front end stuff that gets put on. And, I wouldn't want that average maturity to get back to like anything close to historic lows.
Mm-hmm. Chase, I want to go back to this idea of housing and kind of understanding the trajectory that we are on here. you've recently gone through a bunch of housing charts. How does that inform, this idea, as I mentioned, the trajectory that we're currently on at this moment, and is it comparable to times like 2008?
Interestingly enough, to me, in some ways, it kind of is. Like, if you just looked at how much a house costs versus incomes, like, yeah, it is comparable. In that way, the bubble is just as big. It's just that the quality of credit standing behind it is just so much stronger. And household balance sheets on aggregate are just in great shape. And this is why I put so much emphasis on asset prices. Like, if home prices are up, stock prices are up, like credit's okay, like then everything's fine. Like, you can keep this game going. But I think if you go back to that kind of the scare we had in April, where not only did we have the market, kind of basically in like a month or two gap down 20%. But you also had credit spreads widening out. You had rates going up at the same time. You had the dollar going down at the same time. You had marginal, not huge, but marginal capital outflows from the U.S. finding its way back out into the rest of the world. Like that's like a little taste of what could be a future massive problem. If you ever had capital outflows on a real scale, then that brings asset prices down dramatically. And then all of a sudden, like, that's sort of the prime mover. The trailer isn't going to drive itself. The truck has to drive the trailer, and the truck is asset prices. So that always has to be running in the background. And because that keeps household balance sheets and consumption up, and it keeps that ability to have a stupid house price, because whatever, like, my Nvidia is up, so I can pay the mortgage. It's fine. Because if Nvidia is not up, some people can't pay the mortgage probably. So you kind of have to view this whole ecosystem of between, asset prices and then homes. But let's say we get the stock market down 20%, it holds for a little while. Let's say, lumber prices are up, like, just housing is just getting hit with multiple aspects. And we do see inventories like really starting to move higher. You're kind of back to like 2019 levels for inventories, which got way lower between here and there. So you've normalized inventories, and they're moving up fast. And obviously, supply and demand, you get inventories up a significant amount, especially new home inventories, the ones we build. You usually have to build less. And the reason it's important is because now this could be different because of, again, how much more like tech and services drive the economy compared to like making stuff with their hands. But you do employ a lot of people in building homes. If that takes a decent hit, it could be a demand loss big enough in the economy, because it spreads out. Like, if just home builders lose out, so the contractors that support them, and then the contractors that support them, and then the services that take care of them on their way to work. Like, just the whole thing kind of turns into its own feedback loop. It can become big enough to just take the whole economy. Seems crazy that, a few home builders losing their jobs can take the whole thing with it. But historically, you can kind of see that in the data. It really does work that way. So that is still possible to happen along the way. And to kind of your point, if you go back to '08, like, we're so unaccustomed to home prices being like a real issue. But if you look at the last few months' data, like, you're about as bad as it gets outside of, real quick there in COVID at first and '08. Like, other than that, you just don't get home prices down. Call it, 3-6 month moving averages of the month over month data, stuff like that. That stuff's actually starting to point negative with, like I said, inventories are rapidly moving higher. So it's pretty easy to imagine, barring like really good rate relief, it's pretty easy to imagine home prices being year over year negative nationally at some point in the next year or two. If rates stay up around here. If they get back to like 5.5 on mortgages, then probably a lot of demand comes in, and you kind of make it all okay.
Yeah, just kind of hit that floor again of appetite that comes back in.
Yeah, you can kind of see in the data 5.5 is like a magic spot where, man, you just get at least the last couple of times, like, huge demand wave comes in. Mm-hmm. But quick, this brings up an interesting point to me, and that is, does lowering the front end just automatically lower the 10-year yield, which is kind of where mortgages are priced? Mm-hmm. And I think it's become clear of late, or at least or at least partially clear? The answer is no.
Mhm.
You can have a situation, and I would argue if you got into a situation where, let's say Chris Waller runs the Fed, Trump tells him, "Hey, you're going to cut rates," and he's like, "Yeah, okay," and he, you know, somehow gets the rest of the committee to say, "Okay, let's do it. Let's go 100 bips, right now. Let's go." I would argue because that gets in that weird fiscal dominance realm that the 10-year yield and people out there looking at that would look at that and go, no, thank you.
Mhm.
And you would have, sure, like the 2-year would come down, but the 10-year would almost account for it and you would get a yield rise. Now, sure, we might QE our way out of that or whatever, but let's say we don't. I would say 10-year can go to enough to push mortgages up to like 8. And then, yeah, like good luck with housing at, with 8% mortgages or worse, theoretically. You would have to do, Congress would have to pass laws to do massive subsidies of mortgages or something, or you'd have to QE the 10-year back down, or go back to buying mortgages directly, which they're saying they never want to do again. But um, all those things are more than possible. But that is like a weakness in the system that I don't think enough people think about. I think everyone just thinks like, oh, well, sure, like if we just cut rates, then the 10-year will come down. Sure, it's done that for 40 years. It doesn't mean it will do that, next year.
Mhm. Chase, what about jobs? We see basically downward and fairly substantial downward revisions every month to this jobs number. Does that not get taken into account with these constant revisions being far lower than the initial data that comes out?
Yeah, so I think most of that is because of the birth death model from the BLS, which is obviously broken, and that's the biggest reason I think they always have to come in and there's a lot of seasonality distortions because COVID made things so weird, with like when we do and don't go to school and all that kind of stuff that all the seasonal adjustments were wrapped around. But what I try to do, and it's not that hard, is to sure like take a look at the data as it comes, and then go look at the non-seasonally adjusted data for that part, and then go look. You can just subtract the birth death models, its adjustment to see, a more like we didn't mess with the numbers. Here's what it was, kind of thing. And there's people last year, even the year before, screaming recession because of the revisions. And for me, I went and looked at it, stripped all that stuff out, and it's like, okay, well, you're right. Like jobs aren't as good as they're saying, but like they're still okay. It's not that bad. Um, to me, it's pretty clear we had an insanely hot jobs market in 2021. And since then, little by little by little by little, it's just cooled off. And now you just have like a almost equilibrium, I would call it, jobs market where, you know, you have wages that have come down a ton and they're still coming down. Hiring's come down a ton, it's still coming down, but from insanely high levels. Um, so now you've got to this point where like you can inflect either way. I'm more worried about inflecting lower at the moment, especially because AI obviously like taking some jobs. But one of the best way to look at payrolls, this may help some people out there, is to look at the aggregate payrolls data. And that takes the actual jobs numbers, it takes the hours worked, and it takes the wages, rolls them all up into one thing. And then if you look at that over a long history, you kind of get a good feel for like where you're at. And you're no kidding, like especially in that tight range we were at kind of post GFC for a long time, you're just in the middle of that range. So it's just totally normal jobs market. It's not hot, it's not cold. So that, to me, that should worry everyone on both sides of the debate on, oh, we're about to reaccelerate, and the people that are like, ooh, we're about to tip into recession. Like, to me, the jobs data says either one could be correct. And that's another reason to worry about, losing some of those home building jobs is if any single sector breaks, it becomes like amplified, because it's such a, it's like almost like a really low beta jobs market is a weird way to think about it. And to that point, I have some concern. Go ahead.
It's almost like sitting on the top of a triangle or like a teeter totter.
Yeah, exactly. It has to go. Yeah, exactly. And this is important because not only do you have the home building stuff, but you read through the bill that just passed. Like first, let me make it clear. There's a lot of really stimulative stuff in there. This bill goes both ways. But when you look at the cuts to Medicaid, to Obamacare subsidies, to SNAP, all this kind of stuff, like I look at that, and I'm like, ooh, there's going to be job losses in the healthcare space. That just has to be like a lot less people will have insurance. If you don't have insurance, you go to the doctor less. If you go to the doctor less, a hospital running really tight margins is going to let people go. So I expect healthcare job losses to be a potential significant issue. Now that's a 2026 story because, most of that stuff doesn't go into effect until then. And there's 23 million people that get hefty subsidies on their health insurance that's going to go away. So there's a lot of people that are going to wake up in 2026 and go, oh, my health insurance is $500 more. This is a problem for me. And they're going to, they're going to go cancel some stuff, and they're going to, start, buying cat food and instead of Chipotle or whatever. But so that can become a demand problem while it's also a labor, problem. Something to watch. But like I said, it is also going to be bounced out by, it making the deficit bigger and having some other policies in it that will benefit other sectors. So it's messy.
On the other side of that, though, Chase, we've had another delay, let's say, in the implementation of the tariffs here. And how do you think that this goal of trying to reshore all of these jobs, how do you think that goal ends up playing out here, considering, the lag time with which it's going to take to actually build many of these manufacturing facilities, never mind train and be able to create the jobs that we're trying to bring back, or that Trump's trying to bring back? We
think the way it plays out is it doesn't work, and they have to basically take most of it back, or retool it to make it make sense. Today we had the copper one, 50% on copper imports. And part of that's a negotiating thing, no doubt, but to the extent that it isn't, and that it lives on, and I think what we've proven here in July is that most of this stuff is going to live on. Even in the trade deals you do get, Vietnam cut a deal, and everyone seems to think they did well, and their equities are up. Their effective tariff rate's going to be 25-30%. Like, that's a lot. If that's a win, I don't want to know what a loss looks like. But my assumption is this will create some inflation problems, some supply chain problems. Like the profitability of U.S. manufacturers will be impacted, because it's easy to look at like finished products and be like, well, we don't need that, or we can make that, or whatever. But it's all that same with commodities like copper. Like, cool, like we can just get our own copper. We can do that. But the intermediate stuff, where like, Japan and Korea are sitting at 25. Obviously, China's 43 or whatever. So many things that are like in the middle of our supply chain, where our manufacturers need a thing that comes from one of those countries that plug in the middle, raw materials, that middle thing, and then finished good, where you just jack up the price of their process, smash their profits. And that's not good for our economy, right? And, when I think of the 50% copper tariff, to me, I could see a thing where you say, look, copper tariffs are 1%. They're going to go up 1% a month until they hit 50. And like, go make smelters and refineries and go get your mines open now, because the shot clock is operating. But to go straight to 50, like, obviously you can't just build a bunch of smelters and refineries and copper, mines. Like, copper mines take like 10, 12 years at this point to go from greenfield to being turned on, or brownfield to being turned on. So, and it's not like smelters or refineries are probably, I don't think those get built in 6 months. So I think they'll have to retool that stuff to make it make more sense, to offer a little more time and things like that. So if it sticks at anything close to these current levels, which are not very much different from the original freak out of Liberation Day levels so far, I think there'll be, we'll just reintroduce the pain, and they'll have to make changes again. So I think the like, hey, we want this part of this is like really pretty spot on. Like, we want to protect strategic industries, and we want to rebuild blue collar work. Like, both of those are goals I think literally everybody in America probably go, yeah, we should do that. It's just the implementation of how we're trying, right? The tool set we're using to get there. To me, it's like using a sword and a shield against like a machine gun. Like, maybe don't.
Yeah, that's a good way to put it. I was watching a documentary the other night about basically Apple's move into China, and not only the manufacturing of the finished product, specifically of an iPhone, but exactly as you mentioned, all of the supply chain for all of the parts, the little parts and pieces, little chips that go into each and every one of those finished products. Just the supply chain side of it alone is incredibly complex, incredibly, basically offshored, and just trying to, it's not as easy as just snapping your finger and saying, okay, we're going to make iPhones here. You're still dependent on the rest of the world for supplying every little component that comes from, or that needs to be put into that finished product.
And not only that, but like, maybe I'll probably get hit for being too pro China here, but not only that, but like they're making it cheaper and better than we can, like full stop. Like we can't compete on their price. And at the moment we can't compete on the quality of these things. So now on strategic things, like whatever, like just pay the cost. Like you can't, if you depend on their magnets to build your missiles, that's a problem. You have to fix it. Even if it costs too much money, like you got to fix that. Having a minimum ability. So here's a good example. Like we did the sector tariffs on like steel and aluminum, right? From a strategic perspective, do you need to be able to make some steel in your country? Yes. But instead of doing massive tariffs, like why not just do quotas and subsidize up to that quota? Be like, hey, we at least have to make X amount, and we'll subsidize it to make sure it happens. Like to me, that makes some sense. But to just be like huge tariffs on all the steel, like it's a weird way to do it to me. So to me, you carve out the strategic stuff that you just have to be able to do on your own because it's just too important. And then just kind of let the market take care of the rest instead of, these massive blanket tariffs on countries because then if you do a country, you end up, tariffing, coffee imports that you literally cannot grow in America. And like, why? Right? Like tropical food, like we're probably not going to grow too much of that in Minnesota. So maybe we should just let those countries send it to us for no tariff. I don't know. But you can kind of make the argument we just slipped in the biggest consumption tax in history and dressed it up as trade policy. And if you look at it that way, it's maybe you could just argue like, oh yeah, that's what we were trying to do. And in that case, like, okay, well, I guess a 20% coffee tax is okay then. And no one's gonna get mad at you because they don't look at it that way, right?
Mm-hmm. And I think it's going to take time, to finally see this stuff implemented, if it comes to that, and or time to understand what the actual, real world ramifications are of implementing that tax, as you said it.
Yeah, and I think we'll start to see. A lot of people have already said like, oh, CPI, it's not inflationary. Like, oh no, like this stuff has not hit CPI yet. Late summer, if it hasn't touched it, you start having a case. But really, like a year from now, like I want to know how many manufacturing jobs are there. Like, what do manufacturing, profits look like? What's CapEx look like? Are people building massive factories, like really investing? Obviously, we have a bunch of MOUs not worth the ink they used to print them, but like what does that stuff actually look like? And then to go Friedrich Bastiat, like the seen and the unseen, like yes, we will be able to have some factors to point to, but thinking about the trade-offs of what we could have had and stuff gets important. And then something that I talk about a lot, and that is, I've hammered home, today, like the importance of asset prices for our economy, right? We can hit everyone else over the head with trade because we have, massive consumption. The problem for us is if anyone else wanted to actually fight back, especially Europe, and now it seems like the negotiations with Europe are going pretty well. So this is a very low probability thing, right? But if like, say Europe and Japan were like, you know what, like that's fine. You can hit us on trade. We're going to hit you on capital. We're just going to take our money and go home. Mm-hmm. Then, well, there went, trillions and trillions and trillions of dollars. Our stock market would get cut in half at least if those two blocks took their money home. And then all of a sudden, like, you have a massive problem. So like, I think a lot of people forget that, yes, we run a giant trade surplus, but we run a giant capital surplus that allows us to have really high asset prices that lets us, when we've built our whole system off of asset prices, whether we realize it or not. Um, and so if you kind of unplug that, then you have a massive problem. So fighting on trade is awesome until someone fights back on capital. So we have to be super careful with that. To this point, no one's really pushed that button, thankfully, and hopefully it doesn't come to that. But if it does, that's like a systemic threat to the way we've built our economy.
Well, I mean, exactly in that vein, Chase, you've recently laid out what you foresee from the dollar here. You've been short the dollar for most of this year. So what kinds of things are you taking into consideration when you're determining the trajectory of the dollar at this point?
Yeah, I honestly got lucky to make some money short the dollar this year. I didn't have much conviction in that. It was just more like the technical move worked, and I was like, well, I'm not going to miss this if it's going to happen. And I think we could get some capital outflows on trade. That happened. If you go back to the beginning of the year, everyone was bullish the dollar. So here we are now, and I'm telling you, like, man, everyone is bearish and short. I get like 8 headlines a day from some investment bank or somebody saying like, "Ooh, dollar's in big trouble, just starting, like this is just beginning," or like some trading service like, "Hey, check out these, euro puts, that have devised," and you're like, ugh. You look at the sentiment and the positioning data is all very, very heavy, and that's for me. No matter what the market is, if everyone agrees on it, I'm looking to take the other side, trying to find a way to do that. So just from that sentiment positioning standpoint, I wanted to kind of flip back over to being long dollar. Plus, if you think about the fundamentals, we had the dollar get smacked because we had capital outflows. We decided we were going to, again, go. It looked like we were going to lower the trade deficit and budget deficit. Now it looks like we're going to not do much of either. So I think that was a big underpinning for dollar problems that no one has stopped to think, wait a second, if that was going to be bad for the dollar, maybe us not doing that would be good for it. And then now that you've had 3 really good inflation prints in a row, everyone's convinced themselves tariffs aren't inflationary, inflation's dead, we're fine. So let's slash rates. We had a lot of rate cuts get priced in, and then Europe's kind of like about done for now, cutting rates. A lot of the rest of the world is about done. Some EMs can still cut, it looks like, because they're importing so much deflation from China. But when I look at that, I'm like, well, I think tariffs will be a little bit inflationary at least enough to have maybe 1 or 2 prints, 3 prints, and then the rest of the year. Let's say we have like, I don't know, 5, 6 left, and let's say 2 or 3 of those come in hotter than expected. And next thing you know, year over year, inflation's running north of 2.5 and picking back up on like a 3-month annualized, 6-month annualized, picks back up. Now from the Fed, I'm like, well, I'm not cutting. And so all these cuts have to get priced out from us, while the rest of the world doesn't really have anything priced in anyway. So like that rate differential should kind of blow out to where our rates stay really high compared to other people's, especially since we don't care about the deficit maybe. But so in that backdrop, I could see the dollar having a counter trend rally where we all have to readjust to like, oh, the deficits, both of them are going to stay high, and the rate differential isn't going to do what I thought. And oh, tariffs are a little inflationary. All that should re-rate the dollar back up. Now, I do think it'll be a counter trend rally. So you're talking a quarter or 2 or something like that, not really like a back to new all-time highs or something. But it's going to be tough to get something that pushes you back over to get back down. Now, let's say trade blows up with Europe or whatever, and they do hit that capital button on us, and like cool, like no tax on repatriating money back into Europe. In fact, here's a big bonus for repatriating your money out of the U.S. or whatever. And so people are like, oh yeah, I'll take that. If something like that happened, then all of a sudden like the dollar's just getting smashed, or we get that Waller comes in and manages to actually cut rates the way President Trump wants, something like that. Then the dollar's in the 70s or whatever. So because there's all those things that can still happen that are bad for the dollar, I'm still like I call it medium term, like dollar bear probably. But I have a lot of conviction that we can get a short term, like pretty nice counter trend rally when it looks like inflation, is picking back up a little bit here.
So Chase, how do you see, basically the positioning and this overbought, oversold kind of condition? Do you see the same type of condition in gold, let's say? And do you think that is basically overbought at this point?
I think probably a little bit.
Mhm.
Um, Gold's had a few moments where like the positioning of sentiment were getting stretched. People that never talked about gold all of a sudden it's all they could talk about and stuff. Like I definitely noticed some of that. But it's cooled here lately. And honestly, like all gold really has done is kind of go sideways here lately.
Mhm.
And off of just an incredible move. So even if we flagged for 6 months and went down 20%, like this bull market is still in total beast mode at the end of that, right? But at the moment, it's hard for me to see a substantial fall. But I could see like flat to down 10% rest of the year from here, something like that. And I could easily see us, continuing to kind of slowly march higher. But when I look at sentiment positioning, I think it was a lot worse like a couple months ago than it is now. So I'm actually feeling decent about it. And then my favorite trade from like the last call it year has been platinum, palladium, especially platinum. And now that's gotten real sexy lately. And I think that's taken some people's eye off gold. And then crypto's kind of picked back up. And then trashy SPACs and stuff have like picked back up. So like a lot of people that were probably riding gold were like, something shinier has come along and they've moved on. Which is what, as a gold bull is that's what I want to see. Like all I care about is China's central bank is in there buying every month. And that's been like 8 months in a row they've been in there buying. To me, that's my fundamental for gold is are central banks buying, yes or no? Like if it's yes, I want some. If no, I want to kind of take a hard look and question my allocation. But for now, I see it. Yeah, sentiment positioning is a little concern, but it's not like a major concern the way it is for being short the dollar right now. But at the same time, if the dollar's going to have a counter trend rally up, a little bit, that could be enough to pressure gold down another 10% or something.
Yeah, that's exactly where I wanted to get your take on it. How much of that measuring stick going up or the denominator going up will affect gold.
Yeah, I think it's interesting because in the last few years, I mean, gold's obviously kind of broken its correlation to a lot of things. Real rates has become the famous one because everyone thought that was the big thing, and then it became not the big thing. And I think it's similar with the dollar, where it used to be like, "Ooh, dollar up, watch out." But if you look at the charts the last 5 years, it didn't really care that the dollar was up. And I think just if you have a whale, just sitting there on the tape hitting the bid, like who cares about any of that stuff?
Mm-hmm.
So again, if central banks are going to keep buying, and I think there's a decent chance they will out of structural necessity, then there's a good chance it can withstand dollar higher. With that said, is dollar higher better than dollar lower? No. So could that's why like I think if you put a gun in my head, my base case would be that we're sort of flat, just kind of churn sideways, which is going to feel like a bear market to people. Whenever gold goes up 5% a month every month, and then all of a sudden it goes flat, and people are like, "What's wrong with this thing?" Right?
Yeah.
And I could even see miners being up in that regime when their earnings just keep coming through, just insane.
Mhm.
As long as oil stays down, especially in wages around the world. But so maybe you have a weird catch up scenario where miners finally do a little catch up with the metal for once. But yeah, I'm not too worried about it on the downside. I do think the upside for net, yeah, a little more tame than we got used to. We basically swallowed this thing whole, and now we got to digest it for a little bit. It's kind of the way I see it.
Mhm. Do you think that that's what the mining sector, especially the gold mining sector, needs? Is a couple quarters of outperformance and showing their profitability to reassert their attractiveness within the greater equities markets?
Yeah, I do. For them, I think they almost need other things to struggle for people to really capture that attention.
Mhm.
But if you really look at it though, if you look at like sectors in the S&P, You have obviously tech's doing pretty good, industrials are doing pretty good. But if you made, gold miners their own sector, they'd be crushing those things.
Mhm.
And after enough time, like the average investor is like a T-Rex. It only sees something if it moves. And gold miners have moved. So eventually it's gonna, it will see that and they will buy that. And you see like some momentum stuff has picked up some gold miners lately, which, and that felt pretty impossible in the last 10 years. But now, like, I think your average momentum fund probably has a gold miner or two in it, which is crazy. So yeah, like I do think some of that can help pick them up. I got to be honest though, as someone that likes to traffic in gold miners, like I kind of hope not. Like I like to look at these things and look at what they're worth and look at what they're valued at, and I like to see that giant gap. I'm going to be sad one day when I feel like they're fully valued to a degree. Because now, like the price to NAV for some of them, yeah, just give me giant like buybacks and dividends and go buy stuff for cheap or whatever. Like let the market ignore you. That's fine. But eventually they're going to re-rate a lot higher. And, we'll have to find something else to look at. But
Find something
granted,
else.
they have re-rated a good bit higher in the last 18 months or whatever. It's not like they're just sitting there doing nothing.
Mhm. Well, I think for a lot of people, they're so excited and they've heard about this bull market coming for so long that they expect, 10 baggers at least in every one of them. And
Right.
I don't think that's, realistic in a lot of these cases. But, that kind of brings us to an interesting point here is what do you think? Where do you look at taking profits in some of those cases if and when we do get to some of those, let's say fair valuations?
Yeah, it kind of depends, sadly, on where you got into trades. I think a lot of times, because if you get in early enough to where you like, let's say you were in Alamos for the last 2 years or whatever, like you can already be taking profits, no problem, right? But if you just bought some more speculative play 2 months ago, maybe you're flat on it or something like. What you need before you can take some off is just so different. So it really depends on that from like a pure trading standpoint. But as far as like what to look for, there's a lot of different ways you can do this. Um, I think you can look at like sort of a price to NAV type thing. You can look at forward earnings PE, forward PE, forward PEG ratio, something like that, and versus its own history versus the rest of the industry, stuff like that, like where. It's somewhat because if you do that with a lot of these, well, basically all the gold miners, if you looked at their forward earnings, forward PE ratio, forward PEG ratio, which takes in the growth account too, um, versus their own histories, you're like, wow, these things are crazy cheap. So if I saw though that forward PEG ratio go from the bottom, you know, decile to, you know, back well above like halfway, call it the top quartile, then that's where I'd be like, all right, like the meat of this thing's over. Like, let me get most of my money back here. It's just one way. There's a million ways to think about when to trim or move on. And then obviously there's the chart. If there's a big monster line that's worked great on the monthly chart or whatever, like maybe don't let it hit you. But so a combination of I think technical and fundamental and that kind of stuff goes a long way.
Mhm.
And then just some hey, if you double your money, put half in your pocket. Like that's always a good rule of thumb too. So don't be a pig.
Case, when we think about basically the season that we're going into here, this seasonality of summertime and everybody being on vacation, do you look at this time as time to do research and maybe find positions that you're interested in and kind of let them come to you over this time? Or how do you think about the seasonality that we're just about to enter here, or if not already a couple weeks into?
Yeah, it's funny. It's funny. I love this time of year. To me, it gets a little bit more predictable. When I know less humans are around, I kind of know the machines. The machines don't go to the beach. So I can actually lean, this is more equity market, just broader, but like I can kind of lean more on what the machines are going to do.
Mhm.
So this week's a good example. The market, it's down a little bit, but it's not bad. I feel like if I told you the headlines of today and yesterday and said, what do you think the market did? It wouldn't be like, oh, it's down a little bit. If you told me what happened today and yesterday, I'd be like, oof, are we down 3%, 4%? And I think that's because the humans are at the beach and the machines don't care about the tariffs. They just, especially like, vol control, it just looks at realized volatility and then its historic overlay and goes, cool, I need to buy some.
Mhm.
And it's buying a lot right now. CTAs are still buying. But I like knowing that. So now I can kind of let the market get itself off sides going into late summer, probably. And then all of a sudden, like all the obvious ramifications of all the tariffs start to like flow through in the data. And then the market would be like, well, what's going on here? So to me, you use it and you use knowing that the market's a little thinner. It can be pushed around a little bit more. Like you understand that's the case too. And everything that comes along with that. Like today, gold's down a little bit, and gold miners getting smashed. I mean, same with the oil. Oil's up a little bit, and you have offshore, services stuff's up 5%. It's like that shows you how thin we are right now. That smaller moves are leading to bigger moves, just because there's no one in there to kind of push, to play with. So, um, and then as far as just pure seasonality for what normally happens with equities, like I used to hate that stuff until I had some people describe to me, like, no, here's the reason that seasonality exists and why it's real. I was like, oh, well, that actually makes perfect sense. Like when you have giant pools of capital that do things on a calendar basis, yeah, like okay, it all makes sense now. So leaning into some of those, especially when the setup, is in your favor, like can make sense. So the really bad like 2 weeks of the year, hey, look, if the machines are full and they've eaten all they can, yeah, like if we get a little bit of a vol moving up and options dealers get pushed into negative gamma, it kind of opens the door for like things to happen. Then yeah, that's when I go in there and pound the hedges and try to make some money on some downside capture. And seasonality plays a huge role, in those windows of vulnerability. Those even the options calendar, when you have those expirations, like window of vulnerability has opened here. Usually it closes before anything bad happens, but you have to know when you unleash all that pinned up like positioning from those options dealers that, hey, like you might get some fireworks. So yeah, using the calendar is actually pretty important. I think the average investor probably doesn't really do it.
Mhm. Excellent, Chase. Well, it's great to be able to go through all of these things with you here. Is there anything that you'd like to leave our listeners to consider before we wrap up?
Yeah, if anyone wants to lose money with me, that would be in soybeans. I've been I've been excited about the soybean complex, beans and bean oil, and it has done nothing but not work so far.
That's the
Um,
Houdini trade that you were talking about.
uh, yes, don't, yep. And man, if you look at the chart of just front month soybean futures, it just looks so good, so enticing. But you need some weather cooperation, and let's be honest, 7 times out of 10, maybe 8 times out of 10, that needs some weather cooperation. Don't get it, but that's one for the curious folks out there that are willing to play on the dark side of the agriculture space. Worth a look.
Excellent. Well, we can we can send people over to pineconemacro.com if they want some more information about that. You have a ton of different newsletters and different options there for people if they're interested. And of course on X or Twitter as well at Pinecone Macro. Chase, thanks so much for your time today. I always appreciate getting to speak with you.
Yeah, you too. Always great questions. Appreciate it, Tom.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.